What part of the loan book are they interested in? How quickly can something come together?
Yeah, so listen, this is about a $74 billion loan book. This is not the whole bank by any means, but it is seen as an attractive set of assets. Remember, Silicon Valley Bank had really secured relationships with VCs, their portfolio companies, and while part of that loan book might be extended to some companies that were cash burning, unprofitable, those might be the loans that are less attractive, the riskier they get, but there's a part of that loan book that is very attractive. Remember, the likes of Apollo started lending out very secure assets, secure loans here to things like Tiger Global, SoftBank at the top of the house. So you can see this as an extension of these firms' entrance into the technology universe, into the world of innovation, where they can figure out how to make these loans more secure for themselves. I would also say, Alex, really quickly that, remember, since 2008, there's been this wholesale shift of a lot of lending activity over to the private markets that has only grown. They have raised a lot of money, and you can see this really be an extension of that. Apollo, now looking at these Silicon Valley assets, are very significant after the deals that they've already done with Credit Suisse. So, interesting move into the private markets here.
Herman, just in terms of the context of how this sale is potentially going to happen, we are seeing stability returning. We're seeing a significant bounce in the regional bank stocks today. Is that going to make it easier to unwind Silicon Valley Bank and this process that now lies before us?
I think so. I would also say that Silicon Valley's loan portfolio wasn't the issue that they faced that led to their downfall. Their loan portfolio has been really strong, pristine, really strong credits. 53% of their loan book is in capital call lines of credit, which had only one loss throughout the bank's 40-year history. So we're talking about a very low loss content in their book for their biggest chunk. And about 20% was in startup type loans or to firms that are in the pre-IPO phase. So, and those would be deemed as the most risky.
Herman, how do you value all the different parts of SVB? Because that's going to determine kind of how fast all of this can get done.
Right. So the loan portfolio, we think, is probably the best asset that is still on the balance sheet. The deposits is the murky side because with the depositors made whole, they can really take their deposits anywhere they please. So that's the risk, I think, for any sort of institution that wants to come in and purchase the entity, because you really don't know what's there that's left. There are some businesses like the investment banking business and the venture fund business that I think would be attractive to certain buyers.
Sonali, how does this change the bigger picture around the regionals and the interest that is going to lie with them? Presumably a lot of people are sharpening pencils right now, trying to understand what is happening here. Are they just looking at what is happening with Silicon Valley? Are they looking at other institutions? Maybe there are other deals that can be done with some of these other banks as well.
Yeah, and that's an important question here, because remember, there was so much anxiety over the weekend, Guy, and into the end of last week about capital raising plans and a potential buyer, and there was no buyer that emerged for this firm in whole. And it's because after 2008, there were a lot of liabilities assumed that the banks were really uncomfortable and upset with, given the costs that were tied to those, especially the legal costs. Remember, we've also reported that the Department of Justice is among overseers here, the SEC also, that is looking at the management and the collapse of Silicon Valley Bank. Now, with that all said, there are so many banks that have sold off with the bathwater here. You saw their bonds and their stocks trading a lot lower, and even now they are still worth a lot less than they were last year. They have high net worth clients. They have very attractive kind of base of depositors here. So there are a chance for more mergers here in the banking system, given the attraction, should regulators importantly allow for it. Even in the case of Silicon Valley Bank, what you didn't see here was a bankruptcy filing. And the idea here is that without a bankruptcy, a formal bankruptcy process after that FDIC receivership, you can sell those assets. The investment bank did $9 billion worth of deals last year. The venture business has more than $9 billion worth of assets under its supervision at the end of last year. So there are assets to be bought even without the wholesale bank.
Okay, so Herman, this is perfectly in your wheelhouse. We've seen a huge rally. Clearly, by the dip over the last few days, this is what we're doing today. What banks should be rallying? What banks should not be, in terms of then what happens to M&A?
Right. we really think that the whole price action yesterday was overblown, given the fact that the Fed came in with a liquidity injection with the new program facility, guaranteeing deposits for the failed banks, SVB and Signature. That should have brought the market a sense of confidence. And given the fact that First Republic yesterday was down 60%, seeing that rally makes sense to me because it's a very safe institution, sound, and deposits while maybe outflowing, there's a backstop with the liquidity program. So it all makes sense that we're seeing a relief rally here.
How has, Herman, do you think the regulatory structure around the banking system now changed as a result of deposits, all deposits being guaranteed? How does this change the risk profile around the U.S. banking system, do you think?
Right. So underlying all of this, there's going to be a number of regulatory issues that need to be addressed. We can see regional banks facing more regulatory scrutiny on both the capital side and the liquidity side to match what the largest global systemically important banks now have to face. You're going to see more FDIC assessment charges that the remaining banks will have to pay to the FDIC insurance fund. So those are sort of the issues that will happen to the banks in the aftermath of the fallout.
And we were talking yesterday, it just all increases capital now for banks, right? It's going to raise the cost of doing business. And I'm wondering, Sonali, is that a good or bad thing for Wall Street? Like, does it create opportunities elsewhere, or what's the repercussion of that?
Well, the reason there was this kind of two-tier kind of approach already was because it's easier for the big globally systemic financial institutions to foot these costs than it is for the regional banks. I would say one more word of caution. We're not out of the clear yet. There's a lot of concerns still baking under the system. And the thing I was bothering Herman about a little earlier was the commercial real estate loan books underneath these firms. I think that we really need to watch this kind of situation shake out while regulators make decisions about how they treat a lot of these assets and what they're concerned about through the end of this year.